Hi, I'm Gautam and I'm here representing Group 1 for the Income Tax Planning Group submission. So there are 12 questions in total for the Video Play Act submission questions, and there are 4 of us in our team. So we'll be taking three questions each. I'll be dealing with question 3, 4, and 6. Soheil will be dealing with question 1, 2, and 8. Grishma will be dealing with question 5, 7, and 9. And Huanyu will be dealing with question 10, 11, and 12. So the first question I'll be answering is explain what CCA is and give an example of how it is calculated. So since properties wear out and become obsolete over a time, a cost is deducted from the value of the property over time called depreciation. Now you can deduct depreciation cost over a period of several years. This yearly deduction is called capital cost allowance. Remember, you cannot deduct the full cost of the depreciable property when you calculate a net business or professional income for the year in which you acquire the property. To calculate capital cost allowance, CCA, you need to first categorize under which class does your asset fall under. So similar types of assets are categorized together and classified as one group or a similar group or a similar class. On the Canada website, canada.ca, some common classes of depreciable properties and their rates are given for calculation purposes. So for example, let's take X owns a vehicle he bought this year for $30,000. So now we'll first need to figure out whether this property, which class of asset categorization does this property fall under. So vehicle will fall under either class 10 or class 10.1. Either ways, the CCA that will be charged will be 30%. So there will be one more rule which will be applied here, which is the first year rule or the half year rule, which states that calculating CCA, especially for properties that are bought the same year in which you include the CCA, you have to only use 50% of the base value of the property. So the 50% of base value of the property here will be 15,000 because the vehicle costed us for 30,000. So 15,000 will be the base cost of the property, and 30% CC will be charged on that, which will be amounting up to $4,500. So $4,500 will be the capital cost allowance that will be allowed if you use this property, that is the vehicle, fully for your business purposes. Now, if you use only for 80% of the time you use this for business purposes, and the rest 20% use it for personal purposes, then the capital cost allowance will only be attributed to that 80%, which will be around, in this case, if the 100% was 4,500, 80% of capital cost allowance will be $3,600. Next question is explain what the principal residency exemption is and how it's calculated. Provide a numerical example. So the principal residency exemption is a special kind of exemption given by the Income Tax Act to compensate for the tax payable on capital gains while selling a house. Now, the only condition here is the house should be your principal or primary residence. To qualify for a principal or primary residence, that residence should be in your name and you should have spent at least some time in that house, lived in that house since you bought the house. In Canada, generally while you sell your primary or principal residence, the capital gain tax is exempted due to this principal residency exemption. So to take a numerical example, let's say you bought a house in 2004 for $200,000, and after 20 years today, the cost of the value of the house is $600,000. So the capital gains is $400,000. So if to all these 20 years you spent your this house as your primary residence, then the capital gain will be totally exempted from tax because of principal residency exemption. In another example, let's say in the same example, let's take another case, like you stayed in this house from 2004 until 10 years, which is 2014. And you shifted to a new house after 10 years in 2014 and shifted in a new house, but you still kept this house. After 20 years, now you want to claim the principal residency exemption for the first house you lived in. It won't exempt all the capital gains you make while selling the first house. It will only exempt 50% of it because 10 years out of 20 years you owned is the time you lived in that house, which is 50%. So only 50% of the capital gain will be exempted from tax, which is $200,000. $400,000 was the total capital gain after 20 years. So only 50% of that capital gain will be exempted from tax because of principal residency exemption, which is $200,000. Next question is, what is related party? Provide an example. The word related is defined in our Income Tax Act And individuals will be considered related if they are connected by blood, marriage, common law relationship, or adoption. Now, for the purpose of corporate, two entities can be considered related to each other if they have direct or indirect control over each other, joint control, or they have significant influence over each other. Then these parties will be considered related parties. The concept of related party dealings is like in our text, it is also considered as dealing at non-arm's length, is not defined directly. In the Income Tax Act, rather, it is defined by defining what is considered at arm's length. So, for example, let's say X, a person who's a taxpayer and a personal trust that he has created are both two different individuals, but they will be considered related if the taxpayer X has some kind of a monetary benefit or a financial benefit arising or related with the personal trust. Then this will be called, they will be considered related to each other, and they will also, in other terms, they will also be considered dealing in non-arm's length.
Hello, my name is Soheil, and today I want to answer to three questions. First question is explain how an RSP works, contribution, withdrawal, any special rules. An RSP or registered retirement saving plan is like a special saving account that helps Canadian save for retirement, and it has a different parts contribution. You can put your money into a RSP throughout your working years. And the good thing is these contributions are tax deductible, and you can grow this money into your RRSP account and get investment gain. For withdrawal, you can start taking money out of your RSP once you retire or under some certain circumstances, like the home buyers. And about the special rules, there are special rules like contribution limits. There is a maximum amount that you can contribute to your RSP each year, but if you have unused room from the previous year, you can use it. And there is an age limit for that. And generally, you have to convert to RRSP to register retirement income RRIF or buy an annuity by the end of the year you turn 71. And a spousal RRSP, you can contribute to a spousal RRSP to help your spouse save for retirement and potentially reduce your overall tax as a couple. The second question, explain the primary and secondary residency criteria with examples. The Canadian tax system uses two sets of criteria to determine an individual residency status, primary residential ties and secondary ties. Primary ties like having a place to live in Canada, whether it's own or rental. And if your spouse or common law partner lives in Canada, it's a strong indicator of having ties in Canada. And dependent having children or other dependent living in Canada could be a primary tie. And for secondary tie, these ties less significant than primary, but they are like social ties and economic ties. Having Canadian bank account is an investment or employment. Landed immigrant status or work permits. Holding these documents indicates a connection to Canada. Provincial health insurance, and personal property. And the third question, explain what the operating expense benefit and standby charge is. The operating expense benefits and standby charge are both taxable, and that may apply when an employee uses a company provided vehicle for personal use. And operating expense benefit, these benefits represent the portion of the vehicle operating expenses like gas, maintenance, and insurance. And there is a rate that each year CRA announces it, and we can calculate based on that. So and about the standby charge, these benefits reflects the advantage the employee gets from having a company vehicle available for personal use. Thanks for hearing me. Have a good day. Bye.
Hi, I'm Grishma. Today, I will cover the differences between being a resident and non-resident for tax purposes. What happens when related parties transact at value other than fair market value, and the distinctions between different types of properties. Let's start with tax residency. If I have substantial residential connections to Canada, like owning a home here, being married, or in a common law relationship, or having dependents who live in Canada, I am considered a resident for tax purposes. That means I am taxed on my income from all sources globally. But if I don't have significant ties to Canada and usually live abroad, I am a non-resident for tax purposes. As a non-resident, I am only taxed on income from Canadian sources such as employment, business, or capital gains from taxable Canadian property. Next, let's look at what happens when related parties like family members transact at value other than the fair market value. The Canada Revenue Agency or CRA has rules to prevent tax avoidance in those situations. One such rule is attribution rule. Thus can cause income or capital gains to be attributed back to me if I am the one who transferred the property, wiping out any intended tax benefits. Additionally, the CRA may impose a dimmed deposition, which means they treat the property as if it was sold at its fair market value, regardless of the actual sale price. For example, if I sell a rental property worth $500,000 to my child for just a dollar, the CRA would likely to treat the sale at $500,000. I would then be responsible for paying capital gain tax on the difference between $500,000 and the property's adjusted cost base. Now let's clarify the differences between capital gain, personal use property, listed personal property. Capital property includes assets like real estate, stocks, and bonds that I hold for investment purposes. If I sell those for a gain, that gain is taxable. On the flip side, losses can be deducted. Personal use property or PUP is the property that I use for personal enjoyment, things like my car, home, or furniture. Gains are taxable if I sell the item for more than $1,000, but unfortunately, losses on PUP aren't deductible. Lastly, listed personal property or LLP is a special category of PUP. It includes items like art, jewelry, and rare books. Gains on LLP are taxable, and if I incur losses, those can be deducted against other LLP gains or carried forward up to 7 years. So, for instance, if I sell a piece of art for profit, I will need to report the gains as taxable income. But if I sell at a loss, I can use that loss of offset gains for other LLP sales. Understanding these key aspects can help me navigate Canadian tax laws more efficiently, whether I am a resident or not non-resident, or deal with various types of property transactions. Thank you.
Hi everyone. Next, I will introduce the question 10 to 13. The first example of the tax credit that I want to introduce is the age amount. The age amount represents that the taxpayers who reach age 65 before the end of the taxation year, they may claim on an age amount tax credit, and they also need to subject to an income threshold. The federal age amount in 2019 is 7,000 around, and the age amount is reduced by 15% of the taxpayer's net income in excess of around 40,000, which means that if the taxpayer's net income is below this number, then the age amount would not be reduced. But if the individual's income is over around 19,000, the age amount tax credit is nil. And the second example that I want to introduce is the home buyer's amount. This credit is for individuals who have purchased a qualifying home in the year and they also need to meet some certain conditions, including that the buyer must be the taxpayer or the taxpayer's spouse, or even the common law partner is also permitted. And they do not own and lived in any other home in any of the 4 preceding years of the purchase date. And for question 11, the stock option plans could be taxable benefits only if the employee who received these stock options choose to exercise the option and also purchase or acquire the company's shares. For instance, if Jack is entitled to 100 option to buy the company shares at 10, which is the exercise price, but the company's stock is currently trading at 12, then his taxable benefit would be 200. And for question 13, the passive income is defined as income generated from property, because generating the income requires little or no time or even no physical effort, such as rental income, interest, dividends, and even the royalty are also passive income. So that's all the questions for the play act. Thank you.